Yes, it's done and ready. Now it's live in YouTube also. The topic is same, financial analysis must skill for every banking executive. So whoever have already attended this session on financial analysis, if you want, you can skip. Or if you want to strengthen the concepts once again, you are welcome to attend. Otherwise, you can make a royal skip because line by line, it's going to be same. Let's get started. I'm happy to welcome all of you for this webinar on financial analysis must skill for every banking executive. I also wish to title this webinar as how to analyze financial condition of business without going through years of mainstream finance education. We are now living in the world of online education. COVID lockdown has opened up the possibilities for online learning. In the past several months, you would have attended various webinars, various workshops, online programs. You would have attended your own organizational internal training. But despite all this, if you have registered for this webinar, if you are attending this webinar, it means you are seriously looking for some guidance, you are seriously looking for some learning resources. I can give you that assurance. That is, your next 60 plus minutes is going to be the valuable time. You will have lots and lots of takeaway in this next 60 plus minutes. What you require is guidance from right person. I can give you enough guidance. I can act as a resource person for you. That's the assurance from my side. Okay, so what is the objective of this program? What is my goal? My goal is basically to help out two types of executives: bank executives and finance executives. They should learn financial analysis. Bankers, they should learn financial analysis because when they sanction loan to a borrower, they do credit appraisal, credit analysis, and in that, financial analysis is the core. So bank executives, especially credit analysts, credit managers, relationship manager, branch manager, credit risk creator, sales manager, they should have a good knowledge of credit and financial analysis. Similarly, finance executives, they should understand how banks are going to evaluate their business. They should understand what are the expectations of the lenders so that they can equip the financial position of their business as well. So that's my goal here. Twin objectives. One is to help bank executives. The other one is to help finance executives. So shall we begin? Are you ready? If you are ready, type start. If you are ready, type start. Thank you very much. Let's go through a small story. Over a period of 5 to 6 years, I was training thousands of bank executives on topics like credit analysis, financial analysis, working capital, term loan. This is happening for the past 5 to 6 years. But all this did not happen just like that because I need some foundation, right? How I am teaching this, from where I have learned all this. Let's go back to 2008. In 2008, I joined SBI as credit analyst immediately after my chartered accountancy qualification. I used to say it's just one day before completing my CA program. In campus interview, I was selected. So I had this tag CAN Raja, BCom PGDBA FCA, chartered accountant, and I had that bit of headweight also because completed CA in first attempt, got job in SBI, that too joining as credit analyst. Wow. Okay. So I joined SBI, and first 3 to 4 months that gave me literal nightmares because the profile of credit analyst, credit analysis was not as simple as what I thought. Because in CA final and all, we have done extensive, complicated study analysis, everything. But when I faced that reality, it shocked me. Day in and day out, we'll be getting balance sheets of corporate customers, business entities. You have to read the balance sheet, you have to analyze, you have to read line by line items, you have to read in between lines, you have to arrive at ratios, you have to analyze, interpret them, then see their cash flow statement, fund flow statement, then do the credit risk rating, then put up a appraisal, then attend committee meetings, get firing, answer the questions, and in the meantime, 3 to 4 other proposals will be in queue. Again, you have to analyze different set of customers, absolutely with the different business models. So first 3 to 4 months was absolute nightmare. Despite being a chartered accountant, I faced lots and lots of difficulty in understanding what this credit analysis and financial analysis is all about. But thank God I had good mentors in SBI. They guided me. With their guidance, I was able to pick up things very fast. And within a period of 1 year, I got elevated as team leader of credit processing cell. And over a period of 4 years in SBI, I worked on 250 plus projects. It's 5,000 crore plus size. But what I came across is, despite being a chartered accountant, I struggled a lot. And when I was elevated as team leader, I had newcomers reporting to me who are basically from non-finance background, engineers, science graduates. They struggle in understanding basic accounting. Then comes balance sheet, then comes financial analysis. They had so much of difficulties. So at the time, they used to ask me to teach on basic things. So in the evening time, I used to teach them what is accounting, what is balance sheet, what are ratios, cash flows, fund flows. It started then. It started in 2008 onwards, I can say. And this journey continued for a period of 4 years. Then I came out, I got into CA practice. I had my practice for a period of 7.5 years with more focus on project funding, debt syndication. So again, what I witnessed is, whenever I go to bank, whenever I represent a client, the bankers on the other side were found to be on the weaker position, because client has good knowledge of his business, but bank executive, they are basically shifted from some other department and they have very little idea about what this financial analysis is all about, and many times they fumble. I've seen this. So I started training bankers on credit and financial analysis areas, so that they can approach or they can face their customers very confidently. I started teaching through bank internal training programs. I also empaneled myself as trainer with a few banks. Then I explored technology. And thanks to technology, today I teach close to 2 lakh students, of which 1 lakh 81,000 plus students are in Udemy portal, 20,000 students or close to 20,000 students or in my own portal CA Raja classes, and 95,000 plus subscribers follow our videos and lectures in YouTube. So in this backdrop, I wish to ask you once again, are you really serious about learning financial analysis? Are you really serious about learning financial analysis? If yes, please type this ISAFA. I am serious about financial analysis. Just type ISAFA. I'll keep asking you to type out some small things like this. It's basically to ensure we are connected. For me, it happens now and then. Without any notice, my internet connection will go. Okay, so that can happen even today also. So if at all that happens, I would request you to stay back for another 5 to 10 minutes. In the meantime, I can make some other alternate arrangements. Okay, so if you are serious about learning financial analysis today, type ISAFA.
Let's get started with today's presentation. Financial analysis must skill for every banking executive. As a bank executive, why you have to understand financial analysis? Remember one thing, what is the core business of banking? The core business is lending. And how bank takes that decision? They take that lending decision by carrying out something known as credit analysis, and in that financial analysis plays a very significant role. So if you want to rise up in your organizational hierarchy in bank, you should know what is the core business of banking, and you should be in a position to take that decision as well. So for that, you have to understand the elements, the factors related to that, and in that financial analysis is very important. Financial analysis of whom? Financial analysis of borrowers. Because when they come to the bank approach for a loan, the bank should be in a position to evaluate the customer, then take a decision, and they can do that partly by carrying out financial analysis. And when I say financial analysis, it is analyzing their financial statements, the audited or the past financials, and also their estimated projected financials. And for carrying out that analysis, we are going to use three critical tools. One is financial ratio analysis, two is cash flow analysis, and three is fund flow analysis. Let's get started with financial ratio analysis. I'm going to take you through an example. Let's say there is company A and company B. Company A has reported a profit of 10 crore and company B has reported a profit of 5 crore. If I ask you which company had performed well at this point, what will be your answer?
So this is a baby question or elementary question, but still I want you to give an answer for this. Which company has performed well? Is it company A or company B? With this baby step, we will start learning financial analysis. Okay. So I'm going to throw a poll. Please participate in this poll. Yeah. Tell me, which company has performed well? Is it company A or company B? And I request all of you to participate because this learning process will last in your memory for longer period. It's going to be a 30 seconds poll. Already we are done with 20. Please participate. It's a request. Please participate. Yeah, it's done. Let me share the results. And what is the number you are seeing on screen? So how many of you favored A? Write that percentage. You are seeing some percentage on screen, right? How many of you favored A? Can you type? Basically the percentage what you are seeing on screen. Please type that. 81.1. It means 81, say 82. 82% of you favored company A. It means you said company A is performing better by looking at the profits. Okay. Yeah, that's the figure you have. And let me do one thing. See, for some of you, this question itself is not okay because I have supplied only a limited piece of information and I'm asking you to make a decision or comment which company has performed well. So for some, this is not okay. Okay, so for them, I'm going to give a chance. For them, I'm going to give a chance.
Most of you would say company A, right? Because company A has reported a profit of 10 crore. But if I supply you one piece of information, that is the sales achieved by this company, company A has achieved a sales of 100 crore and company B has achieved a sales of 25 crore. And if I ask you once again, which company has performed well now, what will be your answer?
So I'm asking you once again now, which company has performed well? Now I have supplied additional piece of information. So whoever had that dislike, why I'm asking such a question, now you are given that additional information. So let me relaunch the poll. Please participate. Yeah. So now you can give your vote. Tell me which company has performed well. Is it company A or company B? Again, it's going to be a 30 seconds poll. Let's see. And now I see a kind of a drastic shift happening. Earlier, what was the percentage? We had 81%, right? 81% of you favored company A. And now it's going to be a 30 seconds poll. We are done. Let me end the poll. I'm sharing the results. Have a look at the shift. Earlier, 81% of you favored company A. Only 19% favored company B. But now there's a drastic shift. 85% is favoring company B now. Earlier, only 19% favored company B, but now 85% of you are favoring company B. How did this happen? Earlier, when you took a decision by going through the raw data, almost 81% of you could not make a quality decision, could not make a wise decision. You chose A because you were driven by profits alone. But when I supplied you that additional piece of information, and when you did that analysis, you took even more a meaningful decision. You took even more a wise decision. That's why I could see there is a drastic shift from A to B. 81% A, now it is only 15%. Earlier 19% was B, but now I could see 85% of you are favoring B. 85% of you are now saying it is company B which has performed well. It's because you did that analysis. It's because you started doing financial analysis. So welcome to this world of financial analysis, and let's continue.
There will be a drastic shift, right? Because earlier most of you would have favored company A, but now majority of you will be favoring company B. What happened? When you looked at the standalone figure, it was deceiving because profit of 10 crore looked better than profit of 5 crore. Yes, that's true. But when you gone deeper by comparing the profit with sales, you were able to calculate the profit margin. Company A has reported a profit of 10 crore on 100 crore. It means they have a profit margin of 10%. Whereas company B has reported a profit of 5 crore on 25 crore. It means they have profit margin of 20%. So what's happening? Company B has performed well. In this case, what we have done is we have compared the profit with sales and we have calculated this ratio. Profit by sales into 100. That is what we have calculated as profitability or profit margin. Okay. So ratios are basically a relationship between two numbers which are created in a logical way. Yes, we related sales and profits, and it's a relationship between two numbers, and there was a logic in relating the sales and profit because we can measure profitability. We related current assets and current liability to numbers, and the logic is it helps us to understand the liquidity. Okay, so ratios are relationship between two numbers which are created in a logical way, and it will help us to understand the past, present and future performance, and it will also help us to understand the strengths and weaknesses of businesses. Yes, by looking at the ratio we were able to understand that in which year whether they were stronger in the past or in the present. Current ratio example. And by looking at the profitability ratio we were able to understand like which company is performing well. So we have understood the strength and weakness. So like that we can give many variations. Okay, so that's about ratios, and we are going to understand the ratios by looking at its classifications. Ratios are broadly classified into four categories. They are liquidity ratios, capital structure or leverage ratios, activity ratios and profitability ratios. First, let's get started with liquidity ratios. Already I explained what is liquidity. Liquidity is basically ability of the business to meet its short-term expenses, short-term obligations without difficulty. At this point, I just want to bring the balance sheet here. So those who don't know what is balance sheet is a simple statement which will show from where and all money had come for business and where and all that money had been used. Okay, so for business money can come from owners, we call it as equity. Money can come from outsiders, we call it as liabilities. When money comes from outsiders, it can come with an obligation to pay within 1 year or pay after 1 year. If it comes with an obligation to pay within 1 year, we call them as short-term liabilities because we have to pay within 1 year. And using these money which are basically raised as repayable within 1 year, which we call them as short-term liability, we can use this liability money to create asset, that is short-term asset. But if you look at this, the short-term assets are greater than short-term liability. How it is possible? Because the short-term what is raised in yellow box is smaller, but short-term assets are larger. It means this short-term assets could not have been created without the support of some long-term funds, because only a portion of short-term assets are funded by short-term liabilities. It means there got to be some remaining funds which have been used in creating short-term assets, and that's how it should be for every business. Short-term assets should be greater than short-term liabilities, because short-term liabilities are those liabilities which you have to repay within 1 year, and for repaying that you need resources. Resources will be in the form of short-term assets, so the resources should always be greater than the obligation. That's why I've captured the short-term assets as larger size and short-term liabilities as smaller size. That's how it should be for an ideal business. Okay, right. Now, to understand this liquidity concept, let's first digest this fund utilization principle.
Whatever mentioned in the screen, yes, it's true and I mean it. This is going to be the very, very important segment for you in this webinar. For you, the key takeaway is going to be this part of the webinar, that is fund utilization principle. This is a life-saving principle for many entrepreneurs. You will agree with me once I complete this part. Okay, so my request is keep a laser sharp focus for next 10 minutes, because I will be requesting you to take this message further to as many as possible. Keep a laser sharp focus. And if you don't have notepad and pen, I'm going to give you 30 seconds time. Please go and grab your notepad and pen. Then come and type, I got it. And if you already have it, just type, I have. Okay, so I'm giving you 30 seconds time. Please go and grab your notepad and pen. Then come and type, I got it. And if you already have, just type, I have. Just type, I have. Okay. Yeah, good. Umesh, Naveen, Sivakumar, Suraj, Anand. Great, great. Fine. So let's get started.
Whoever attending this webinar, whether you work in a bank or whether you are an entrepreneur or a finance manager or a chartered accountant or a cost accountant, okay, please take this principle to your heart, to your mind, and try to teach this to as many entrepreneurs as possible, because several businesses fail because of not understanding this principle. Okay, now listen. I said money for business can be raised from the owners, we call it as equity. It can be raised from outsiders, we call it as liabilities. And this liability can be short-term liability, and these short-term liability can be used for creating assets. They are called as short-term assets. But here if you look at short-term assets are greater than short-term liabilities, it means some portion of short-term assets are funded by long-term funds. I call them as long-term liabilities and equity. So this gives rise to the understanding that equity, the money contributed by the owner, is always long-term, and other long-term liabilities. Liabilities means repayable. So it can be a term loan, it can be a debenture. Okay, right. So if you look at the composition here, short-term assets are created using an entire portion of short-term liabilities and some portion of long-term funds, I call it. So you still have some more long-term funds which can be used for creating long-term assets. Now comes the fund utilization principle. If you are raising short-term funds, you can use it for creating short-term assets. It is good. If you are raising long-term funds, you can use it for creating long-term assets. That is also good. If you are raising long-term funds, you can use a portion of long-term funds for creating short-term assets. That is considered as ideal. But one thing that should never ever happen in any business is never ever use short-term funds for creating long-term assets. Never ever use short-term funds for creating long-term assets. Why do I say that? Short-term funds are raised with a promise that you will repay within 1 year. And if you want to repay within 1 year, you should have invested that money in short-term assets, because only those assets can be converted into cash within a period of 1 year, so that you can use that cash to pay back the short-term liability. On the other side, if you use the short-term liability on creating long-term assets, by very name, by very nature, they are long-term assets. It means those are all the assets which cannot be converted into cash within a period of 1 year. So you borrowed with a promise you will repay within 1 year. So when the due date approach, if you look back, you will not have short-term assets. What you will have is only long-term assets. Long-term assets, by very nature, by very definition, they cannot be converted into cash within a period of 1 year. Then you will carry sorry figure, or you will carry sorry face with your lender. Imagine that short-term liability, that short-term fund was given by a banker in the form of a cash credit or overdraft. And when they demands the repayment, and if you don't have a matching short-term assets because you have already used that money in long-term assets, what's your position? You will not be able to sell that long-term asset. But this lender, the banker who gave you that cash credit, who gave you that overdraft, will hardly wait for 90 days. 90th day they will classify the account as non-performing asset, and they will go for legal recovery measures, and that becomes the beginning of end of a business. Okay, so understand, diverting the short-term funds for long-term purpose is suicidal. Most of the business, they do not realize this. They think all money are same, but short-term money have very high pressure because they have to be settled in the short-term period. But long-term money, they are cool because you have to settle them over a period of time only. Just imagine you take a home loan, you have to pay over a period of 20 years. Your obligation will also be manageable. But for that entire home loan amount, if you go and take an overdraft, imagine the kind of pressure. Will you be able to settle that entire home loan amount within a period of 1 year? It will not happen, right? So if at all you raise an overdraft equivalent to home loan amount, and if you put that in constructing a house, it means you are not constructing a house. You are constructing something else which I don't want to mention, because it's going to put you in trouble. It will give you sleepless nights. Okay, so never ever do this. Let me give some numbers so that we can understand it better. I've raised short-term funds of 100 million, and I've used that funds to create short-term assets of 70 million only. So here comes the problem. I've raised short-term funds of 100 million, but the short-term assets what I have created out of it is only 70 million. So the question is, what happened to that remaining 30 million? And the answer is very obvious. It is not in short-term assets. They are in long-term assets. They are in long-term assets. So what I've done here, I've diverted the short-term funds of 30 million for long-term assets. And I've also raised some long-term funds of 70 million, which I've used for creating long-term assets of 70 million. So my total both sides are 170 million. But here what happened is I've raised 100 million, of which I have spent only 70 million for short-term purpose. Then I did that blunder, unpardonable mistake of diverting the short-term funds for long-term purpose, 30 million. This is going to put this business in serious trouble, because the lender, whoever have given that 30 million, they will come and ask for the payment within period of 1 year. And for paying them, I don't have short-term assets, because the existing short-term assets is only 70 million. For that there is a corresponding obligation of 70 million. Whereas for the remaining obligation of 30 million, I don't have short-term assets. What I have is only long-term assets. Long-term assets I cannot sell just like that. It will take its own time. And those lenders will not wait till I settle my long-term assets, or till I sell my long-term assets. Okay, that's where the problem starts, because bankers are permitted to wait only for 90 days. Then they have to go for legal enforcement. If it is a supplier's money, probably he'll give you 2 or 3 calls, then he'll go for legal enforcement. That's where the problem starts. Okay. So here there is a diversion of 30 million, and this 70 million they have used for a long-term purpose only. That's okay, but the blunder, the mistake, the sin what was committed here is diversion of 30 million short-term funds for long-term purpose. Okay.
So, how many of you find this principle useful? Because this is the principle which is going to save thousands and thousands of businesses. Several businesses have collapsed in this country not because of technology, not because of product, not because of marketing, not because of HR, not because of labor. No, no, no. Several businesses, for that matter 95% of businesses are failing only because of this reason. They divert short-term funds for long-term purpose. They don't realize that they are committing this mistake. For some of you it might have sounded like I'm exaggerating because I've used the words like sin, unpardonable, blunder, everything. It's basically to drive the message because this is so serious. The businesses which has committed or which has committed this mistake, they find it extremely difficult to come out of it. Okay, because the consequence will be that serious. It takes so much time. Very few units make it up, others they collapse. Okay, that's why I've stressed so much on this. And if you find this useful, type useful. Yes, I could see many of you said this. So I'm going to place a request now. Since you have understood this concept, since you have understood the concept, I'm going to place a request. And since you said it is useful, I'm going to place a request. The request is you have to teach this to others. Okay? Please teach this to entrepreneurs whom you know. Tell them there is a principle like this. Tell them don't divert short term funds for long term purpose. If you do so, these are all the consequences. And by the time you realize, you will be in deep trouble. Okay? Tell them. Because in my experience, wherever I have presented this, the feedback what I got is why nobody taught this to us? Why our school system? Why our education system? Why even our bankers have not taught this to us? If you had come and said this some 5 years back, 10 years back, our story would have been altogether different. That's the kind of feedback I received from entrepreneurs. Okay, that's why I'm placing a request now. Please teach this to entrepreneurs. Please teach this to your friends who are working in bank, because it's going to save the bank. It's going to save the financial system in the country. Okay, so all of you, will you type? Can you just type IWT? Can you just type IWT? It means I will teach. Okay. Diverting short term funds for long term purpose without funds arranged. Okay. Without funds arranged for a meeting, that will always put that business in trouble. Okay. Thank you. Let's continue.
With this understanding, let's get into liquidity ratios. Liquidity ratios are broadly classified into 4 ratios, and in this webinar we are going to focus on the first one that's very important, that is current ratio. So current ratio scenario should look like this, because we know how to calculate current ratio, which is current asset by current liability. Okay, but current ratio scenario should be like this, that is current assets should be greater than current liabilities, and we calculate the current ratio like this, current asset by current liability. If current assets are greater than current liability, it means the resources are greater than obligations. Okay, let me take you through 3 scenarios. Look at this scenario 1, where the current liabilities are given. Okay, so this is total current liability, which is 300, and the resources that are available to settle that obligation is available. Okay, so the obligation is 300, resources are 600. So I think here the liquidity position is really comfortable. If I plot this in a form of a graph, the red bar indicates the resources, blue bar is the obligation, and here you can see there is a comfort zone. We call that as positive net working capital. How I have calculated? I've compared the current assets with current liabilities. So there are excess current assets. Excess current assets means that portion of current asset is not created by current liability, but they are rather funded by long-term funds. The portion of long-term funds used for creating current asset, we technically call it as net working capital. So if a business is having positive net working capital, it is a good sign, because to that extent that business will not have liquidity pressure. Okay, here they have 600 million as current assets and 300 million is the current liability. So they have pressure only for 300 million. For the remaining 300 million, they don't have pressure because it can be settled over a period of long time. Okay, that's what we understand when current ratio is like this, like 2:1. Let me give you another scenario. Here the current liabilities is same and current assets, there is a difference. Okay, look what's happening. Current liabilities are 300 and current assets were also 300. So you have an obligation of 300 million. For that you have resources of 300 million. It looks like a perfect scenario, but that's not the case. Okay, because let's say the bank CC has become due. This 100 had become due and you can settle that using your cash and bank balances. Then when this 200 becomes due, what are the assets you have? Only the stock and receivables. Let's say the receivables are getting converted into cash. That's good. So out of 200 you settle 100, but still you have another 100 pending. So what will you do? How will you manage? Because you cannot settle your suppliers with the stock. You purchase stock from them. You cannot pay them in stock. You have to pay them in cash. And you cannot tell them, please come and take back my stock. If you say so, then that becomes end of the credit business for you. You will not get credit from any suppliers in future, because that supplier will take care of the task of negative marketing for you. Okay, so that's why I said this scenario, even though it looks like an ideal scenario, it is not ideal. It's not an ideal scenario, because some of the current assets will not come for rescue when you want them very desperately. Okay, let me take you through scenario 3. And here the current liabilities are same, whereas current assets are comparatively lesser. Look at your current liabilities, it is 300. Look at your current assets, it is 200. So here you can see the problem. You have to settle 300 million within a period of 1 year, and for settling that you have resources of only 200 million with you. You have to settle 300 million, but you have only 200 million. So how will you manage that 100 million? That's the question. Okay, that indicates this business is going to land in trouble, number one. Number two, this will also communicate their financial discipline. They've raised 300 million short-term funds. They should have created short-term assets of 300 million, but what they've created is only 200 million. So the question is, what happened to that remaining 100 million? It's very obvious they have diverted it for long-term purpose, and they have committed that sin or blunder of diverting the short-term funds for long-term purpose, which will put that business into serious trouble. Okay, so if I put that in a form of a graph, look, the blue bar is the obligation and red bar are the resources, and clearly you can see there is a shortage, and to that extent this business is in a danger zone, because here the resources are lesser than the obligations. So when your current assets are lesser than the current liability, that is current asset minus current liability, obviously your net working capital will be negative. You will have negative net working capital. Okay, so let's capture all the three scenarios here. Scenario 1, current asset 600, current liability 300, so the net working capital was 600 minus 300, 300. Net working capital means the long-term funds which were used for creating current assets. So here if you see 300 long-term funds and 300 short-term funds put together, current assets of 600 was created. And if I look at the current ratio, it is 300 by 600, it is 2:1. In scenario 2, there is no long-term fund contribution at all, and the ratio is 1:1. And in scenario 3, 200 is the current asset, 300 is the current liability. It means there is a negative net working capital. Negative net working capital indicates a diversion of short-term funds for long-term purpose. So whenever you come across a negative net working capital, it means there is a diversion of short-term funds for long-term purpose. And whenever there is a diversion of short-term funds for long-term purpose, the current ratio will also be below 1. Here 200 current asset divided by current liability 300. 200 by 300, you are going to get the current ratio as 0.67:1. It means for every 1 rupee obligation, they have resources of only 67 paise, which clearly shows there is a shortage. Okay, and this also means that there is a diversion of fund. At this point, I want to ask you a question. Since some of you or most of you are working in bank, what is the minimum current ratio insisted by your bank? What is the minimum current ratio insisted by your bank?
Yeah, please tell me, what is the minimum current ratio insisted by bank, your bank? I could see 2:1, 1.33, 1.33. Naveen is saying 1.25. Sivakumar, Umesh, Anand, 1.33. Bikash Rao, 1.31. Rupendra is saying 1.33, 1.33. Okay, I see majority as 1.33, and I could also see different current ratios. So this means current ratio, the minimum current ratio could vary bank to bank. It could vary based on whether the borrower is into manufacturing, trading, services. Okay. Now just give me a minute.
Shall I take a couple of minutes to explain the logic behind a minimum current ratio of 1.33? Why banks are insisting on minimum current ratio of 1.33? Shall I explain?
Shall I explain this? If you're interested, just type BIO. It means bring it on. So I'll be able to break that logic and put it in a nutshell form. And this is something which you will really cherish, because so far you know there is a minimum current ratio. And for some of you, you may be already knowing the rationale, but for many, it can be like a rule you are following. But what is the reason why bank is insisting at particular level? Once you understand, once you realize the logic, then you will start falling in love with what you do. Okay. So that's why I'm asking you to type BIO. And again, it is also an internet connectivity check. Let's continue.
Okay. Let's say I have current assets of 100 million and current liabilities of 75 million. And with this information, if I calculate the current ratio, it will be current assets by current liability, and it is 100 by 75. So it is 1.33. 100 by 75, and it is 1.33. So what I can infer is, when my current ratio is 1.33, it means 75% of the current assets are funded by current liabilities. And what is even more important is the remaining 25% of the current assets, that is current asset minus current liability, the remaining 25% of the current assets are funded by long-term funds. Funded by long-term funds, we technically call them as net working capital. So when the current ratio is 1.33, we can safely conclude that 25% of the current assets are funded by long-term funds. It means there is a 25% long-term fund contribution for creating current assets, and that's what most of the banks stipulate as margin for working capital. For example, if you go and check the sanction letter issued by most of the banks, they would have stipulated 25% margin for working capital credit facilities. Even if you look at the Tandon Committee recommendation for arriving at working capital, they said that 25% of the current assets have to be funded by margin, and it is only the remaining 75% banks can explore funding. Okay, it means there should be a 25% contribution of long-term funds for creating current assets, and that is verified, or that is checked through current ratio. If current ratio is 1.33, then there is 25% contribution. If it is greater than 1.33, then there is greater than 25% contribution, and if it is less than 1.33, then there is less than 25% contribution. And that's the reason most of the banks insist on current ratio of 1.33. Okay.
So this is the logic behind minimum current ratio of 1.33. For some of you or for many of you, this could have been just a rule book, but today that logic was unfolded or logic was opened. Okay, so how many of you really see this as a logic opener? If you got that concept clear, if it is a bulb on moment, just type bulb on, just type bulb on. This is not a rocket science, okay? So I do not take any much of credit for having explained this, but it's just a concept which many of you just ignored. I've just opened it for you, okay? Yeah, thank you very much.
Now let's move on to capital structure ratios. Under that, there are three ratios, but here we are going to discuss about what is important from banker's point of view, that is debt to equity ratio. In debt to equity ratio, what we'll be doing is we'll be comparing the debt with equity to understand the long-term solvency of a business. Let me take you through a balance sheet. I'm just going to show you the left-hand side, that is the equity and liability side. Look at this, shareholder funds are 100, bank loan is 100, debentures are 100, and sundry creditors are 200 million. It means this business has raised 500 million from 4 different parties: owners 100 million, from bankers 100 million, from debenture holders by issuing debentures 100 million, and from suppliers, sundry creditors 200 million. Now what we have to do, what we are trying to understand, it is debt equity ratio. So we have to compare the debt with equity. Equity is the owner's money. In this case, it is this 100. And debt is the sum of all the three. We call them as outside liabilities, and it is 400. So let's compare the debt with equity. Debt is 400, equity is 100, and the formula for debt equity ratio is debt divided by equity. 400 by 100, we get the value as 4. Let me take you through a scenario, a 3-case scenario, so that we can understand it better. The first scenario what we are discussing now is total outside liabilities of 400, equity, the money contributed by the owners, as well as the profits that are attributable to them put together, we call it as equity, 100. So if I calculate the debt equity, that is total outside liabilities divided by equity, 400 by 100, I get the value as 1, and we express it as 4:1. It means for every 1 rupee contributed by the owner, this business has borrowed 4 rupees. For every 1 rupee contributed by the owner, this business has borrowed 4 rupees. So what we can understand, if this business is raising 5 rupees, 4 out of 5 rupees is by outsiders and 1 out of 5 is contributed by the owners. That's what you see here. Outsider share are 4 out of 5, that is 80%, and owner share are 1 out of 5, that is 20%. So what's happening here? In this business, owner's stake is very less, whereas outsiders have contributed more, and I see this as highly risky proposition. Because this 80% of the funds which had come into the business would not have come free. They would have come with a cost, and these costs have to be met, let whatever be the situations surrounding the business or affecting the business, because they are all fixed cost. Look at this, in this case 400 million they have raised as debt, and they have to pay interest, they have to pay principal, let whatever be the market condition. Only in rare exceptional circumstances the regulators will step in and give direction to the banking system to not to demand for payment for some time, like what we have COVID. Reserve Bank came and said give them moratorium for 3 months, then give moratorium for another 3 months. Okay, but it will not happen every year. It happens only in rare situations. So in this case, this 400 million, they have an obligation, and that has a fixed cost in the form of interest, in the form of loan principal repayment, and they have to be met. And if for some or the other reason, if their sales comes down, and if they are not in a position to meet that commitment, meet that obligation, this business will get affected to the core. Because whoever have given money, they'll not wait for long. They go for legal recourses, and that could come as a big blow for the normal operations of this business. Okay, So that's why I say 4:1 is a highly risky scenario. Let me give you a second scenario where the outside liabilities are 333 and equity is 167. I chose these numbers to convey an important message. Because look, the total funds are 500. Here also it is 500 only, but I've chosen a different proportion. The proportion works like this. If you take the debt 333 and if you divide it by equity of 167, you get the debt equity ratio as 2. We express it as 2:1. It means for every 1 rupee contributed by the owners, this business is borrowing 2 rupees. It means if this business is raising 3 rupees, 2 out of 3, that is 2/3, that is 67% is coming from outsiders, and 1 out of 3, that is 33% is coming from owners. And for me, this is much better than scenario 1. In scenario 1, outsiders contribution are 80%, where in scenario 2 it is only 67%. To that extent, there will be reduction in fixed cost as well. In scenario 1, owners have contributed only 20%. In scenario 2, owners are contributing 33%. I see that as a good sign because owners will be investing more of their money when they see their business is more promising. Let me take you through scenario 3, where total outside liabilities are 250 and equity is 250. Again, I have maintained the total as 500, but I have changed the proportion. So what is the debt equity ratio now? 250 by 250, it is 1:1. It means if this business is raising 2 rupees, 1 out of 2, that is 50% share is coming from outsiders, and 1 out of 2, 50% share is coming from owners. And this is much better than the first and the second scenario, because here the outsiders share have come down, and as a result the fixed cost related to that will also come down. Fixed commitment, fixed obligation will come down. This will reduce the burden, it will reduce the pressure on the business. And owners are investing 50%. It means they know this business is very much promising. That's why they are committing their money. So what is an indication? The indication is scenario 1 attracts high financial risk. Scenario 2 we say ideal, and scenario 3 is the best. Okay, so this ratio, that is debt equity ratio, or we call it as TOL, total outside liability, by T and W, that's basically the equity. Okay, that communicates the long-term solvency. Businesses with a high risk, businesses with high level of ratio will have a high financial risk, and because of that, it's possible that during recessionary market conditions, those businesses may not be able to withstand, they'll get washed away. Because when their sales comes down and if their fixed cost is going to remain fixed only, it means the impact is reduced sale, higher fixed cost, so the profit will turn out to be loss, and that business will have its natural death. Okay, so that's what we are trying to understand through this debt equity ratio. So whoever working in bank, you will know, because you will be carrying out credit rating of the customers, and in my experience the highest weightage is given for the single ratio, that is debt equity, or we call it as total outside liability by tangible net worth.
Okay, so that's about debt equity ratio. Now I just wish to know what is the maximum debt equity level considered as tolerable by your bank. Can you just type out what is the maximum debt equity considered as tolerable? Yeah, Shrikant is saying 4, Naveen 3, Shivkumar 2. And one thing, let me make it clear once again. So in this webinar, I'm introducing several concepts, okay, for the first time, on the assumption that you do not know much about it, okay. So for some, it will be a new concept being opened up, and for some, it's already something they know very much. So it's nothing, okay. So my assumption here is you know nothing about any of this. So I am taking you through baby steps. So if at all I take so much of interest in asking you something on basic elementary things, do not feel otherwise, because here I make an assumption that you know nothing about financial analysis. I'm teaching you like ABCD. Okay. Yeah. So thank you very much. And I could see the ratios like 4, 3, 2, 5. So see, there is a variation. So this variation can happen because of the sectors. It can be manufacturing, trading, services. Accordingly, the ratio can vary. And it can also depend upon each bank's risk appetite. Some banks, private sector banks, they'll be willing to take more risk. Okay, they may go up to 5, or they may go, say, maximum to 4. But some banks, say public sector banks, who are very conservative, they'll say, no, no, we'll not go anything beyond 2:1. Is that okay? So it could vary based on bank's risk appetite. It could vary based on the customers, that is borrowers, industry, whether he is into manufacturing, whether he is into service. So we cannot prescribe a one size fits all approach. We cannot prescribe a one size fits all approach. Okay, right. Let's continue.
Let's move on to the next very important topic, that is working capital holding levels. As a banker, this is very critical for you, because when you sanction working capital credit facilities like cash credit, you have to understand what is the working capital holding levels, because that only influences the working capital credit facilities. Okay, let's get started. This working capital holding levels can be subclassified into inventory holding period, debtors collection period, and creditors payment period. I'll take you through one by one. The first one is inventory holding period. I'll take you through two scenarios, scenario 1 and 2. In scenario 1, I'm giving you information about cost of sales. Cost of sales is 120 million. So please note, here I'm not giving you the sales information, rather what I'm giving you is cost of sales. So this excludes profit. Okay. Now, when they achieved a cost of sales of 120 million, they are maintaining an average inventory of 10 million. So how to look at this? In one full year, they have sold goods, and for that the cost what they have incurred is 120 million, and on an average always they maintain an inventory of 10 million. This is scenario 1. Scenario 2 also, cost of sales is same 120 million, but average inventory what they maintain is 60 million. Okay, now let's see. We have annual cost of sales. Now I can easily find out monthly cost of sales by taking the annual cost of sales divided by 12. So 120 by 10 will give me monthly cost of sales, which is 10 million in scenario 1, and scenario 2 also it is 10 million only, because my cost of sales is 120 million. Now I have two critical information. One is monthly cost of sale. I also have information about average inventory. Look at the scenario 1. The average inventory maintained is 10 million, and monthly cost of sales is also 10 million. So I can say the average inventory maintained is equal to 1 month cost of sale. Whereas if you look at scenario 2, average inventory is 60 million, whereas monthly cost of sales is 10 million. So I can say the average inventory is 6 times of monthly cost of sales. How I derived this? I derived inventory holding period. I just took average inventory, I divided it by monthly cost of sale. In scenario 1, 10 million by 10 million gave me the value as 1. It means this business is maintaining inventory equivalent to 1 month cost of sale. Whereas in scenario 2, they are maintaining inventory of 60 million divided by 10 million. It means they are maintaining inventory equivalent to 6 months cost of sale. So this will communicate a lot to the bankers. Because when a customer is maintaining inventory only for a period of 1 month, their profitability will be more, because they are not locking their money in inventory, because they keep less of inventory, but they were able to achieve sales. It means there is a kind of rotation happening, turnover is happening. Whereas if you look at scenario 2, they are maintaining inventory for 6 months. It means they are going to have several other costs, and because of that their profitability will be less. It means they have to spend on storage cost. There is a possibility that goods will get damaged. They have to spend on finance cost, because their money is locked for 6 months in godown. They have to find alternate money. They come to bank itself for a loan, and that comes with a finance cost which will have impact on the profitability. On the other side, instead of bank money, if they are putting their own money, there is an opportunity cost because that money could have been invested elsewhere, which could have got them even a better return, because now it is just coming to fund what is logged in the godown. Okay, so these kind of impacts can be assessed by looking at the inventory holding period. So when the inventory holding period is less, that business will have more profitability. And when inventory holding period is more, when it is beyond the industry benchmarks, when it is beyond the past levels, that will have impact on the profitability. Okay. Next, we'll move on to debtors collection period. I'm going to take you through a similar scenario. Scenario 1 and 2. And here what I'm giving you is annual credit sales. In scenario 1, annual credit sales is 120 million and average debtors is 10 million. In scenario 2, it is 120 million, but their average debtors is 40 million. Okay. Now we know annual credit sale. So let us find out monthly credit sale, which is nothing but annual credit sale divided by 12 months. 120 by 12, it is 10 and 10 in both scenarios. Now you just compare this average debtors with monthly credit sale. Monthly credit sales is 10 million and debtors is also 10 million. So we can say debtors is equal to 1 month sale. But in scenario 2, debtors is 40 million, whereas monthly credit sales is only 10 million. So we can say the debtors is 4 times of monthly credit sale. So we can express that as debtors collection period, which is nothing but the average debtors divided by monthly credit sale. In scenario 1, it is 10 by 10. It means this business is taking 1 month to collect money from its customers. Whereas in scenario 2, it is 40 divided by 10. It means this business is taking 4 months to collect money from its customers. So here we get the message. The message is in scenario 1, the collection is happening at a faster pace. Whereas in scenario 2, it's slower because they're taking 4 months to get their money back. And what will be the impact? This slow collection will have impact like liquidity strain because your money is locked with the customer. So you have to manage your show by borrowing from bank or elsewhere. So that comes with a finance cost and which will have impact on the profitability. And when you give it on credit, especially for a longer period, or when the customers are taking longer period to pay you, there is a possibility that they may end up not paying also. So bad debt losses. And when you bring in your own money to manage because of this funds getting locked here, there is an opportunity cost. Okay, so this is debtors collection period. In the same way, we can also interpret creditors payment period. Let me put all the numbers here because it's very similar to the debtors collection period what we have discussed. Okay, look at here. Scenario 1, the monthly credit purchases is 10 million. Average creditors is also 10 million. So we were able to conclude that they are taking 1 month to make payment to the creditors. Whereas in scenario 2, they are taking 4 months to make payment to the creditors. So what that means, it basically communicates the payment speed. In scenario 1, the payment is happening at a faster pace. It's good for the business. In scenario 2, the payment is happening at a slower pace. Here, the decision that payment is happening at a slower pace should be arrived only by comparing with the credit period what is offered by the creditors. If the creditor themselves are giving 4 months credit period, then that is not an issue. But if the creditors are giving only 1 month period and if this business is taking 4 months to settle the creditors, then that indicates various other things. Because slow payment could mean that this business is not having enough money to make payment to the creditors. It means they are having liquidity strain. And when the payment period is getting extended, there will be high finance costs because the suppliers will load penal charges. And when creditors are not paid on time, then the creditors can even go for a legal recovery action. So it could also indicate potential future problems. Okay, so these kind of inferences are possible by looking at the working capital holding periods, basically the inventory holding period, debtors collection period, and creditors payment period. Next, we'll move on to coverage ratio. In that, first I'm going to explain debt service coverage ratio. We call it as Dscr. This ratio is calculated to measure the repayment capacity of a borrower when he approaches a bank for a term loan. So how repayment capacity is measured? It is measured by finding out the cash profit available for debt service and comparing that with the repayment obligation for every year, which is interest plus principal. So here, how this cash profit available for debt service is computed. Let me show. what we do is we take profit after tax and dividend. With that, depreciation will be added back. Reason being, depreciation is a non-cash item. Not even a single penny cash goes out in the name of depreciation. Okay, since we want to find out cash profit, what we do, we add back depreciation, because while arriving at the profit after tax, this depreciation was subtracted as an expense, but no cash goes out, so we are adding back depreciation. Then we are also adding interest, not because it is a non-cash item, but because we want to know what is the cash profit available for paying interest and principal. If you want to know what is the cash profit available for paying interest and principal, you cannot take cash profit which is after paying interest. Okay, because we are starting with profit after tax and dividend, right? This profit after tax was arrived after subtracting all expenses, which also include interest. So let us add back that so that it gets nullified. So by doing this, taking profit after tax and dividend, and by adding depreciation and interest, we arrive at cash profit, and this is the formula followed by most of the bankers. Let me take you through an example so that you can understand it better. Look at this statement. This particular business has made a sales of 1000. Their direct cost is 500. Their gross profit is 500. Operating expenses are 100. Depreciation is 100. Interest on loan is 100. So from sales, direct cost was deducted 500. They had a gross profit of 500, and we are deducting 3 expenses. So from gross profit, when we deduct all the 3 expenses, we get the profit before tax. So 500 minus 300, you have as 200. From that, let's deduct tax at 50%, which is 100. So you get profit after tax of 100. Now listen. For computing debt service coverage ratio, what we have to do? We have to take profit after tax. With that, we have to add back depreciation and interest on loan. In this case, there is no dividend, so we are starting with profit after tax. So 100 plus 100 plus 100, 300. This becomes the cash profit. This cash profit have to be compared with the repayment obligation, which is basically interest on loan of 100, what we have seen, plus interest on principal I am giving you, which is 100. So what is the total obligation? 200. What is the cash profit? 300. Now we can find out debt service coverage ratio. Dscr is equal to profit after tax and dividend plus interest on term loan plus depreciation divided by interest plus principal. In this case, it is 300 divided by 200, and you get as 1.5 times. You get the value as what? 1.5 times. And what does that communicate? For every 1 rupee loan obligation, which is interest plus principal, this business is having a cash profit of 1 rupee 50 paise. So it looks good, right? Because for paying 1 rupee, they are having a cash profit of 1 rupee 50 paise. It means from 1 rupee 50 paise, 1 rupee can be paid off. Still 50 paise is available with that business. They can use that 50 paise for supporting their working capital requirements. Okay, right. Now I want to ask you a question. What is the minimum DSCR insisted by most of the banks? If you're working in a bank or if you are exposed to this concept, please give your answer. What is the minimum DSCR insisted by most of the banks?
Yeah, I could see Shrikant saying 1.25, Bikash Rao 1.75, Umesh 1, Rupendra Singh 1.25. What about others? What is the minimum DSCR? See, and again, this also varies, no? So this also shows the risk appetite of the banks. Okay. Shivakumar is saying 1.5. Dibanshu is saying 1.25. Okay, okay.
Okay. 1.1 will be insisted by the banks who are ready to take risk. Okay, because 1.1 is a very small ratio. If they are okay with that, it means they are willing to take more risk. It means the side effect is the interest rate will be very high. 1.5 is accepted by most of the bankers, and 1.75 is insisted by public sector banks, okay, who are very conservative. They'll be insisting a DSCR of 1.75. Now let me take a couple of minutes to explain the DSCR rationale, why some banks are insisting on 1.75 times, or say for that matter even 1.5 times. Why banks are insisting on DSCR of 1.5 or 1.75 and not just 1? Because if DSCR is 1 for paying loan obligation of 1, they are having resources of 1, why not banks stop with that? Why they are insisting on 1.5 or 1.75? Shall I explain?
Shall I explain? So this will be again a logic opener, and I can assure you a bulb on moment, unless and until you know this already. Okay. Yeah. Please type BIO, bring it on. This is basically an internet connectivity check. Thank you.
Okay, let me explain the rationale behind this minimum DSCR. Look at this. If DSCR is 1.75 is to 1, it means for every 1 rupee obligation, there is a cash profit of 1 rupee 75 paise. So from 1 rupee 75 paise, 1 rupee can be paid, and what is left with the business is this 75 paise. This 75 paise is the profit after tax, after dividend, after paying interest, and after paying principal also. So it basically goes as retained profit, and this retained profit will go to a head called reserves and surplus in balance sheet under the head equity. And equity along with other long-term liabilities will become long-term funds, and that long-term funds can be used for supporting working capital margin. If this does not make sense for you, worry not, look at this. Your statement of profit and loss only communicates what is profit. From that we calculate cash profit. Then we compare that with the obligation and we arrive at DSCR. And if DSCR is 1.75, it means out of 1.75, 1 can be paid, 0.75 can be retained in the business. And I told you that this retained profit will go to balance sheet under the head reserves and surplus. So now this reserves and surplus along with capital will be called as equity, and this equity along with the long-term liabilities will be called as long-term funds. These long-term funds can be considered or can be used for creating long-term assets. I repeat, these long-term liabilities can be used for creating long-term assets. But if you look at the proportion, look, you have so much of long-term funds, but only a portion of long-term funds has been used for creating long-term assets. It means there is some surplus. So what's going to happen here? This business is also raising some short-term funds. It is creating short-term assets. The short-term assets are more than the short-term funds. How it was made possible? Because short-term funds are very small, but short-term assets are much bigger than that. It was made possible because the remaining surplus of long-term funds, has been utilized for creating this short-term assets. Now try to link with our fund utilization principle. We said a portion of current asset should be funded by short-term funds and another portion should be funded by long-term funds, because I said I marked it as ideal. Utilizing the long-term funds for creating short-term assets is ideal because that is going to relieve the business from liquidity pressure. So if a business is having a DSCR of 1.75, that 0.75 gets retained in the business. It gets retained, it becomes part of long-term funds. So that long-term funds, after being utilized for creating long-term assets, there will be some surplus. That surplus will in turn get utilized for short-term assets, and this is what we call as long-term funds used for creating short-term assets. Technically this is the net working capital. Okay, so it is not that mere profit along with capital along with long-term liability, they all become put together long-term funds, and they are actually supporting short-term asset creation. So this is the logic. I hope you would have understood.
Yes, for how many of you this is a logic opener? If you have really understood the concept, just type bulb on. Bulb on is what I look for from my students, because that means I am teaching well, the communication process is complete, and this only gives me that personal satisfaction. Okay, thank you very much.
Next, there are general profitability ratios. Within that, you have 5 set of ratios where basically you will be comparing the profits with sales, and there are also return on investment ratios. There are also return on investment ratios where the profits will be compared with investments, capital employed, owner's money, but I'm not getting into these because we have some more minutes where we have to touch on the cash flow and fund flow. So I'll take your approval and get started with cash flow analysis. Here I need your participation. Look at this. There is a company which has made or achieved a sales of 100 crore by incurring expenses of 60 crore and reporting profit of 40 crores. So now I have a question for you. The question is, what is the cash generated by this business? Sales is 100, expenses are 60, profit is 40. So what is the cash generated by this business?
Yeah, now you can give your answers, and here also it's a baby step in cash flow analysis, like what we did in ratios. So for some of you, you may get some numbers, and for some, it can be like a scenario where you don't have adequate information to take a call. So whatever is the situation, okay, based on that you can give your answers. You can either say inadequate data, or you can give a number. Yeah, Umesh is saying data not sufficient. Mohit is saying 100 crore. Rohit is saying 40 crore. Shrikant saying can't say from this data. Rupendra is saying 100. Okay, let's see how this goes.
The cash generation can be equal to profit when they have realized their entire sales of 100 crore and met their or paid their entire expenses of 60 crore. It means 100 crore had come in and 60 crore had gone out, so the profit will be equal to cash. But it can also be greater than 40 crore, it can also be less than 40 crore. It can be greater than 40 crore when you have realized the entire sales and you have paid only part of the expenses. So here you have cash as 70 crore. And it can be less than 40 crore when you have realized only the part of the sales and you have paid full expenses, okay, or most of the expenses. So you have realized only 70 crore but you have paid entire 60 crore, so here your cash is only 10 crore, okay. And this can also undergo a change. This cash of 70 crore can come below 40 crore. It can even come below it can come below 70 crore. It can even come below 40 crore. And this cash of 10 crore can go above 10 crore. It can even go above 40 crore. How? Let's say a loan has been repaid 40 crore. Some machinery has been purchased for 20 crore. It means out of 70, 60 crore gone. So what is the cash position? It is now only 10 crore. And in the second scenario, let's say a debenture has been raised, money has come in for 30 crore. Some asset has been sold, 20 crore money had come in. Equity, money had come in from owners, 20 crore. So we have 70 crore money coming in. So now the total position is 80 crore. So what we have to understand is, in business, cash is not generated merely by profit. It is from various activities. We call them as cash flows from operating activity, cash flows from investment activity, and cash flows from financing activity. Look at this 70 crore. This is a cash flow from operations, operating activity. Whereas this 40 crore repaid is a result of financing activity. They raised finance in the past. They're repaying that now, financing activity. Look at this machinery purchase 20 crore. They are investing their money. It's an investment activity. Whereas this debenture of 30 crore money coming in is the result of financing activity. And they've sold assets 20 crore. They are disposing of their investments is a result of investment activity. Whereas this equity 20 crore which had come in is a result of financing activity. And finally, the 10 crore cash is a result of operating activity. So what we can infer is, in business, cash can come in and go out under three activities: operating activity, investment activity, and financing activity. So in a year, if you capture all this, cash flows from operating, investment, and financing activity, and if you total them, you get to know what is the cash generated during the year. And with this, if you add the opening cash and equivalents, automatically you will get the closing cash position, closing cash and cash equivalents position. And this is something known as abridged cash flow statement. So what's happening here? I'm capturing the cash flows from operating activity, investment activity, financing activity. I'm aggregating them so that I can get the cash generated during the year. And with this, when I add the opening cash balance, automatically I get the closing cash balance. Okay. So this statement, by having a look at this statement, I'll get to know from where money had come and where money had gone out. Okay. And it also acts as a reconciliation statement, because by adding the cash generated during the year with the opening balance, I get the closing balance. Let me show you a real life cash flow statement. It will look something like this, with many line items and subline items. But being part of bank executive, being part of bank, your focus should be on how to read the cash flow statement, because the preparation of cash flow statements are taken care by accountants. So you should know where you have to keep your eyes. Okay, look at this cash flow from operating activity. It's a positive figure of 4,60,600. Look at this investment activity. It is a negative figure of 1,75,000. So the positive figure of 4,60,600 from operating activity means they've run their business for one full year, and from operations they've made a positive cash. Whereas investment activity negative figure means they have paid 1,75,000. Cash had gone out to the extent of 1,75,000 because they have made some investments. So some other assets have come in. So if you want to know what are those assets, you have to go back to the statement. Look, they have purchased plant and machinery. They have purchased some investments. Then look at the next key item, that is investment activity. Sorry, financing activity. The next key item is financing activity, and it is a negative cash of 2,70,000. It means to that extent cash had gone out. And if you want to know what are those components, you can go to the cash flow statement and you can see. And now if you add all the three, you get to know what is the cash generated during the year, and it's 15,600. So when I look at this, what I infer is they made 4,60,600 from their operations, and they use their own money for making some investments. And despite spending on investment, they had so much of money, so they are very easily settling their financial obligations. And despite all this, they still have positive cash of 15,600. And here we need not worry, because they made so much of money, but everything has gone out. We need not worry, because look at their opening cash and cash equivalent position. They already had 1,50,000. So this 1,50,000 plus what they've made during the year, if you add, still at the end of the year, their position is really comfortable. It's actually better than the previous year. Previous year it was 1,50,000, and at the end of the current year it is 1,65,600. So when I look at the cash flow statement, things are looking too good. But you should also be very cautious, because sometimes businesses will be showing good amount of profits, but cash flows from operating activity will be negative. It's because most of their sales are logged with the customers, or most of the money is logged in the inventories. So because of that, cash flows are not happening, so they'll be struggling. So for a healthy business, what is required is a positive cash flow from operating activity. Look at their investment activities. Is it positive or negative? Positive means they are disposing of their investments. They are getting some money out of investments. If they are disposing of their investments, if they are selling their investments, what assets are they selling? Are they selling the core assets or non-core assets? If they are selling the core assets, then the question of going concern will arise. Because by selling their core assets, how they will continue their operations in future? Or if they are selling their non-core assets, it's a good strategy, because they are infusing liquidity into the business by disposing of the assets which are not required for running the show. Look at their financing activity. If it is a positive figure, it means money had come into the business. From whom that money had come? Is it from owners? Is it from outsiders? What are the terms? All those can be explored and it can be understood. So these kind of critical information are possible by going through cash flow statement. Okay, and I'll take some more minutes, couple of minutes, not couple of minutes, some 3 to 5 minutes to explain fund flow analysis. I need your participation here. Look at this. There are 3 companies A, B, C, and you have information about their long-term sources and short-term sources, total sources. You have information about their long-term uses, short-term uses, and total uses. I want you to digest this information. Spend some time and then identify which company is in trouble here. Is it company A or company B or company C? Company A, they've raised long-term funds of 50. They've raised short-term funds of 50. So total of 100, of which 50 is used for long-term, 50 is used for short-term. Company B also raised in the same pattern, but of which 70 is used for long-term and 30 only used for short-term. And C raised in the same pattern, but of which 30 only used for long-term and 70 is used for short-term. So you have to tell me like which company is in trouble.
Okay, so think over, because it's here we actually test the fund utilization principle. Okay, yeah, I could see Rupendra saying C, Srikanth saying B, Shivakumar saying C, Umesh, Rehan, Umesh and Rohan saying B, whereas Rohit Kumar, Divanshu is saying C. Okay, so it's a kind of combination. Let's see how this goes.
Let's see the results. I'm going to rearrange this statement. Let me bring the long-term sources here and I'll compare that with long-term uses. So let's see what is the position. If you take company A, long-term sources and uses are same, so no surplus, no deficit. But company B, long-term source is 50, long-term use is 70, so there is a deficit of 20. And company C, long-term source is 50, long-term use is 30 only, so there is a surplus of 20. And now let me take short-term sources. I'll compare that with short-term uses. And let's see what is the position. For company A, obviously no surplus, no deficit. But company B, they raised a short-term fund of 50 and used only 30, they had a surplus of 20. And company C, they raised only 50, they've used 70, they had a deficit. So it might look like company C is in trouble because they had deficit, and company B is comfortable because they had surplus, but that's not the understanding. Pay attention here. Company B, they raised a long-term source of 50, but they created a long-term use of 70. How is that possible? With 50, you cannot create 70. So from where they got the remaining 20? Obvious, they got that remaining 20 from here. So this short-term surplus of 20 with the long-term source of 50, they got money worth 70 million, which they've used for long-term purpose. And because of this reason, we say company B is in trouble. Because company B, they raised a short-term source of 50 and their short-term resources are only 30. It means they are supposed to repay 50 million in 1 year. With that promise, they raised 50 million, but what they have done is they have created only 30 million worth of resources. They have simply diverted 20 million for long-term purpose. So within 1 year, they are supposed to repay 50 million, but they have resources only 30 million with them. So whoever have given that 20 million, they'll go for legal action against this company for not fulfilling the obligation, for not fulfilling the promise. For not fulfilling the promise. In this case, company B, they'll not be in a position to fulfill the promise because that 20 million they have invested in long-term asset. Long-term use. It can be land, building, plant and machinery, and you cannot sell them just like that. It will take more than a year, but they will not wait for more than a year. Okay, that's why we say company B is in trouble. But if you look at company C, they've raised 50 million long term, they've spent only 30 million, they had a surplus of 20 million. And that surplus of 20 million along with short-term fund of 50 million, they've created short-term use of 70 million. And if you look at it from the other side, within 1 year they are supposed to pay 50 million, and for paying that 50 million, what are the resources they have? 70 million. That's why we say company C is in comfortable situation. Okay, right. So this statement which helped us to get more clarity is fund flow statement. Let me give you a real life fund flow statement. It will look something like this. Okay, it's basically part of it. Look, here you have the sources and here you have the applications. Sources we basically call as long-term sources. Application we call as long-term users, like what we have seen here. Okay, now look at this. Let me analyze this also so that you will get complete clarity about fund flow analysis. And here I'm not teaching you how to prepare fund flow statement, but I'm teaching you how to read the fund flow statement. Okay, look, in 2018-19 they had long-term sources from operations and by selling investment of 5,650, And these are all their long-term uses. They purchased plant and machinery, they paid taxes, they paid dividend. Okay, so 5,650 was the source, 6,200 was the use, there was a deficit of 550. Let's analyze this. So what is the total source? It is this 5,650. Okay, when they had 5,650, what they did, they first purchased plant and machinery. Okay, not first, they purchased. Okay, all right. Since they had so much of fun, okay, 3,700 is okay, because even after paying all this, they'll have a surplus of 1,950. And then what they are supposed to do, tax is compulsory, they cannot escape. Okay, from 1,950 they paid taxes of 1,100. So they are left with 1,950 minus 1,100, 850. Okay, when they are left with 850, they did this mistake. When they are left with the long-term fund of 850 only, what they did, they went and paid dividend of 1,400. What is the amount they have? 850. But what is the dividend they have paid? It is 1,400. How? It's not acceptable, right? But they did that. How? They went and paid 1,400. They faced a shortage of 550 and they have managed that shortage by using short-term funds. Okay, so here there is a deficit, and this deficit was managed because they took some short-term funds. A simple example can be a cash credit or overdraft, because they wanted to pay 1,400 to their owners, but they have only 850. So what they did, that 850 plus money available in cash credit or overdraft to the extent of 550 put together, they have paid dividend of 1,400. So this shows their financial discipline. When they have only 850, why they are paying 1,400? That's not right, right? I mean, this is not a wise approach. Or ideally what this business should have done, when they have purchased plant and machinery of 3,700, here they should have raised some long-term funds. So some portion of this 3,700 could have been funded by long-term funds, and that would have left good amount of surplus so that they could have paid this dividend easily. Or the other way is, when they have an investment to take place like this to the extent of 3,700, why they are paying dividend? They could have used this money for funding that, right? They didn't do. They paid dividend when they don't have adequate funds. When they had only 850, they paid 1,400. They simply diverted short-term funds for long-term purpose. So this is what happened in 2018-19. In 2018-19, or ideally they could have done one thing. When they are left with the long-term funds of 850, they should have restricted their dividend to 850. In that case, there will not be any diversion of short-term funds for long-term purpose. But even it should not be like that, no, because there should be some long-term surplus contributing for working capital of the business. Here, instead of contributing, they have stolen the money from cash credit for paying as dividend to the owners. Okay, see how powerful the statement is. It is revealing what was hidden. Let's see what happened in 2019-20. In 2019-20, their funds from operations have improved significantly. They've also raised money by issuing debentures. So it is 7,800. And from that, they are purchasing plant and machinery. Okay, they have a lot of money, let them. It means after purchasing plant and machinery, they have surplus of 5,025, and they want to pay taxes. Okay, good, let them pay. So from 5,025 taxes paid, what is left over now? 3,325. From that, they want to pay dividend. Okay, let them pay 2,250. It means the balance left over is 1,075. At this point, they should have put a break, but what they did, they went and purchased an investment of 1,500. When they are left with the funds of only 1,075, it means this is the grave mistake which they should not have committed. 1,075 is the surplus, 1,500 investment, not in their business. They have purchased investments, some shares or stocks of some other company. By using whose money? By using some short-term money. Look, they have only 1,075, but how they spent 1,500? The 1,075 plus 425 gave them 1,500. They've invested in someone else's business. This business is not learning from its mistakes. When they are left with 1075, they should have stopped at that level. They should have ensured that this money is going for supporting the working capital requirements of the business, but they didn't do. Okay, so these kind of all hidden practices will get caught, will get revealed in fund flow statement. In my 4 year of stint in State Bank of India, the statement for which I had high regards is the fund flow statement, because this is one master health checkup report which will reveal all the hidden problems of the borrower. I mean, if at all you will get awestruck, or if at all you will become unanswerable in one statement, means that is fund flow statement, because it is so clear. Okay, because it shows, no, like from where they got money, where they have used. See, they have paid dividend in 1819 when they didn't have money. They've invested in someone else's business in 1920 when they did had money. So this all shows the intentions, the integrity of people behind the show as well, not just numbers. It also goes deeper into qualitative aspects. So that's the power of fund flow statement. So develop your skill in reading fund flow statement. Such a powerful statement. Okay, all right. So with this, I wish to conclude this presentation, and I believe most of you would have had a bulb on moment. So if you really had a bulb on moment, please type bulb on.
Yeah, please type bulb on if you had that bulb on moment, if you derived value from the session, if you had learned something meaningful, useful, if you believe that, yes, I could present things as you expected, please type bulb on. Thanks a lot. Thank you very much. Thanks a lot. What you have seen now is only the tip of the iceberg. What you have seen now is only the tip of the iceberg. But the best part is you have understood whatever I have explained so far. Thank you very much. The reason why I say it's a tip of the iceberg is because in reality, when you do the credit appraisal, when you do the financial analysis, you have to read balance sheet line by line. You should focus or put your attention on every item in balance sheet. You have to analyze various set of financial ratios. There will be liquidity, solvency, profitability, return on investment ratios, various set of ratios. Then you have to study the cash flow statements in depth. You have to focus on item by item items. You should see where they generated money, where they have used, how they have used. Then you should also study their fund flow statement in depth, and again in between the lines, to identify whether any fund diversion have taken place. Then you should develop special skill for assessing the working capital requirement of the borrower. Here you got to empathize with the borrower, but at the same time you should also protect the bank's interest. Next, you should be able to put up a comprehensive loan proposal if a borrower comes for a term loan for putting up a project, because this requires viability study. You have to look into their repayment capacity, Dscr, fire, break even, sensitivity, and so on. Next, you should also be able to work seamlessly on CMA report, the basic Excel document which captures the past financial data as well as the current estimate and projection. And from this only all kind of analysis will happen. Next, you should be able to arrive at credit risk rating for the borrower. You should be able to come across different types of business entities, business models profile, and you should also be able to understand the forex impact on import export transactions. So what all this means? All this means you got to learn more, right? So how many of you are really ready to learn more? Because once again, I reiterate, what I have showed you today is only tip of the iceberg. So how many of you are interested in learning more? If you are really interested in learning more, if you want to take this journey to the next level, if you want to improve your skills that is required for your job, and that's the fundamental for your banking career, then type ILM. ILM stands for I am interested in learning more. ILM stands for I am interested in learning more. Whoever interested, please type ILM. Thank you very much. Can I have your permission to introduce the courses which I have published for bankers, which will solve all the problems we discussed? If you're permitting me, just type yes. Just type yes. I'll take that as your approval. Thank you very much. Let me introduce the courses. But before that, whoever interested in getting certificate for this webinar, I would request you to wait for another 5 to 10 minutes. I'll be sharing a unique code which you have to fill in the mail which you'll be getting after this webinar. Then you become eligible for getting certificate of participation. And we also promised 2 ebooks, one on financial analysis and the other one on working capital management. You will get access to those ebooks in the email after this webinar. And we also promised access for a free crash course on banking credit. You will be getting access for that as well in the email. So keep an eye on the email. You'll be getting email from CA Raja classes at carajaclasses.org.
Financial and Credit Analysis Mastery Bundle. It's a bundle of courses I have designed for financial and credit analysis purposes. To start with, we have course number 1, Banking Credit Analysis Process, worth rupees 499. In this course, I have covered credit analysis, financial statement reading skill, ratios, fund flows, cash flows, then types of business loans, working capital, cash credit. You can see there are more than 20, say more than 30 topics, and everything is connected with banking credit process. So that is included in this bundle. Number 2, how to carry out financial analysis as a banker. In this, you will learn financial analysis through ratios, through fund flow analysis and cash flow analysis in depth from banker point of view. Number 3 is how to carry out term loan appraisal and assessment as a banker. As we know, term loan is a technical process. It requires a lot of technical analysis, and all those are covered through section 1 introduction. Section 2 covers TEV study. Section 3 talks about cost of project and means of finance. Section 4 deals with production factors. Section 5 technical analysis in term loan appraisal. Then comes course number 4, how to prepare CMA report for bank loan. In this course, through 8 sections, I have covered CMA preparation process in depth with case studies. Then comes course number 5, how to read balance sheet. In this course, I have picked up a real life balance sheet from stock exchange and have explained all these aspects. You can have a look at the screen. I'm not reading it out. Then comes course number 6, that is how to read CIBIL report. And in this course, I have explained all about CIBIL, how to read CIBIL report, covering 6 sections, namely CIBIL TransUnion score, personal information, contact information, employment information, account information, inquiry information. Then key terms related to reports were also explained through a separate section. So basically, it's a 6 courses bundle of each 499 rupees worth. So 499 into 6, the overall price is 2994. But you are special. You have attended this webinar. You have spent more than 60 minutes. It means I'm going to give you a bonus. Already 6 courses. Here comes course number 7, where you can learn banking credit analysis through case studies. Course number 8, where you can learn how to prepare cash budget for bank loans. And course number 9, which deals with credit policy, products, delivery, appraisal, risk and rating. So how many courses? Already 6. So now 9, and comes here course number 10, export finance, priority sector lending and retail loan. So 10 courses. It should be of value close to 4,990, but you are going to get it for same 2,994. It means all these 4 courses comes to you at free of cost. And you deserve even more bonus because you are sitting still this point. You have that desire to learn. So come here, course number 11, which deals with basic elements related to bank loan proposal. Course number 12, it's a comprehensive course. It's finance for non-finance executives. Many of the bank executives come from non-finance background, so this course is going to be their life savior. Then course number 13, financial statement analysis, a complete study. So now you have 13 courses of value close to 8,000 rupees, but you're going to get all for the same price of 2,994. Okay, so it's not yet over. You still have some more bonus.
That is course number 14, how to carry out credit risk rating for non-trading entities. Course number 15, master class on working capital management. Course number 16, basics of forex management. So 16 courses of value close to 9,500, but you are going to get it for same 2,994. Not yet over, you have even more bonus. I'm going to give you a lot. Next comes course number 17, which is Collateral Securities, a comprehensive study. Course number 18, Basics of SARFAESI Act. Course number 19, Registration and Licenses Required to Run a Business in India. And course number 20, Accounting Basics in 66 minutes. So I have introduced 6 courses related to banking, financial and credit analysis, the core courses, and you are going to get free bonus of another 14 courses. It means you are going to get access to 20 courses of value close to 11,500. It's 3,000 plus lectures, and you are going to get lifetime access both in mobile apps as well as website, and all this for just price of rupees 2,994. And you are also going to get bonus access to various free resources comprising 11 ebooks. Okay, it's an ebook on current ratio, debt equity, cash flow statement, capital structuring, financial break-even. It goes. I'm just running them. And you are also going to get some more bonus. It's career guidance material, basically the professional courses you can pursue while working in bank, and also a career guidance material related to certified credit professional course. And you will also get access to test series on ratio analysis. Okay, so it's 20 courses, 15 resources of value close to 13,000 rupees, 3,000 plus lectures, lifetime access, accessible in mobile app and website. All this comes to you for a price of rupees 2,994 only. So why wait for? Enroll now. So thanks for this opportunity. I'm going to share the link. Please check your chat section. Whoever watching this in Zoom, check your chat section. Whoever watching this in YouTube, check the chat section as well as description below. I'm placing the link now, and this link is valid only for next 20 minutes. So if you want to continue your learning journey, if you want to take it to the next level, if you want to make best use of this opportunity, your time is on now. It's going to be next 20 minutes. I'll stay back, and whoever enrolls now, I'll be calling out each and every participant's name. I'll be giving my live acknowledgement and assurance. I want to ensure this entire process happens transparently. So if you believe that this webinar has added value for you, and if you want to continue your learning journey, now the ball is in your court. Please click on the link. It will take you to the course. If you already have a student account in CA Raja classes, directly you can enroll. Otherwise, it will prompt you to open up a student account, and then you can complete the enrollment registration process. Let me also share some of the feedback given by our earlier students. Just have a look at it. If you still wonder whether you should enroll in this package or not, just look back your past 60 plus minutes you have spent. Just try to answer all the 4 questions. Question 1, did you really understood what was explained? If answer is yes, whether you are able to relate with the things that were explained in this webinar. If answer is yes, if you derived value in the 60 plus minutes, and if answer is yes, and if you had that aha moment or bulb on moment that you have learned something really meaningful, useful, then I would suggest go and enroll confidently, because you will get that throughout this package, throughout the courses. That's the assurance from my side. If you have this question as to how you can access these courses, just have a look at the screen. If you enroll now, you can access them in desktop, laptop by visiting our portal. You can also install our app We have app for Android phone users as well as iPhone users. You can download the app from Play Store, App Store. Just search for CA Raja classes. And the courses, whatever you enroll, will be available in the app also. And the best part is you can download the courses into your mobile within the app, and you can access them later even without internet connection. After enrolling the course, if you have some doubts or if you need some guidance, we are going to provide you 24 by 7 lifetime support through our Telegram community. We have a community for financial analysis where 1000 plus bankers have already signed up. This is only for paid students who are coming to this specific course. You can ask all your questions and you will get reply. You can also learn from question answers of other participants. So thank you very much. Thanks for giving me this opportunity to introduce my courses as well. And as I said, whoever is going to enroll now, I'll be calling out your name. I'll be giving my acknowledgement, and I will also give my assurance. Do you know what is the assurance I'm going to give? The assurance is you are going to get 100 times of value for the money you are going to commit in this course. Okay, it means you are going to invest your hard-earned money in this courses, and the value what you are going to get for that is 100 times of the amount you invest. I'm saying that with lot of courage because I know how it has helped students, how it has helped our bank executives in learning things fast, in achieving a transformation. Okay, so what I'll do, I'll open my email because as and when a student enrolls, I'll be getting a notification and I'll be getting a copy of invoice sent to them as well. With that, I'll be able to call out the name of each and every participant who are enrolling now. I can give my acknowledgement as well as assurance. And today morning as well, we had several participants signing up for this program. Okay, so let me just open up my desktop. And I have noticed that Rupender Singh has initiated the registration process. Yeah, Rupender, once I receive your payment, I'll give my acknowledgement and confirmation. Okay. Yeah, Naveen. Okay, Naveen is asking for some time. Naveen, can you just drop me a mail? My email ID is endratca@gmail.com. Okay, drop me a mail. See, I can tell you, I mean, you can go for this courses with 100% confidence. Okay, absolutely, your money is not going to go waste here because you have spent 60 plus minutes now. Yeah, Rupinder, I'll come to you. You have spent your 60 plus minutes. You are better placed to take a decision. You are better placed to take a decision because you have all the information at your disposal to take a decision. Okay, and I am giving you an assurance. I am giving you an assurance that this will be your finest investment. Okay, so let's see who is that. We have our first participant. Yes, that's by Rupender Singh. Rupender Singh, this is an acknowledgement message. Yes, thank you very much. Thanks for the trust. And the acknowledgement is yes, I have received your payment. And what prevails over here is the trust. So thanks for the trust. Thanks for believing me. Thanks for investing your hard earned money in our courses. I deeply value this. It's because for some executives, this can be as good as 10% of their salary. And if you are taking a decision to commit that money, then I am always answerable to you. Okay, so once you enroll in this, you will get access to our Telegram community, and Telegram community is 24 by 7 support group. So whenever you come across a doubt, come and post that in the Telegram group, and we are there to help you out. It means we have created a community. There are 1,100 plus banking students like you already there, and on a daily basis, we are having discussions on various matters. Okay, so Rupender Singh, thanks a lot. Thanks for the trust. Thanks for believing me and investing your hard-earned money in these courses. Now I have a request for you. I've seen you are an action taker. You have taken the action. You are going to get the results. But it requires one more concerted effort. That is, you have to spend 30 to 45 minutes every day. I repeat, you have to spend 30 to 45 minutes every day on these courses. And today you have spent more than 60 minutes. You didn't have any difficulty. Okay, same thing will continue. Spend that 30 to 45 minutes consistently for next 11 days. If you can do that for next 11 days, take it from me, it will become your habit. Once you create a habit, then in 3 to 4 months you will be able to complete this entire package, and I can give you an assurance that there will be a transformation within yourself. Okay, there will be a transformation. You will see a better version of yourself. You will gain significant knowledge and authority, and you will achieve mastery in financial analysis. Okay, so that's the assurance from my side. Thank you very much. As I said, please spend that 30 to 45 minutes. After this webinar, I will be sending you a WhatsApp message. That WhatsApp message will have details like how you can access the courses. It will have details like our app for Android phone users as well as iPhone users, and you will also get access to our Telegram group community. Okay, so thank you very much. And let me check who else are in that process. See, whoever in the process of registration, let me know. And if any of you are facing difficulty also, let me know. If any of you are facing difficulty, yeah, I could see Shrikant initiated the registration. I could see Umesh Chakma initiated registration. If any of you are facing difficulty and if you need Google Pay or Phone Pay option, let me know. I'll share my number. Okay, because it's possible that when many try to purchase the same course at a time, some payments may not go through. So that's why I'm giving you an alternate payment option. And as and when you purchase, I'll be getting a notification here. With that, I'll be able to call out your name. And as I mentioned already, I want to keep this entire process as transparent as possible. And I want to give my acknowledgement to each and every participant. Okay, yes, we have our next participant. That's by Umesh Chakma. Umesh, thanks a lot. Umesh, thanks a lot for trust. And this is an acknowledgement message. Yes, I have received your fee payment. Okay, thanks a lot. And warm welcome to our students community. And thanks a lot for the trust. Now, I have a request, as already I made it to Rupinder. The request is please spend that 30 to 45 minutes every day. Do that for 11 days. See to that it becomes your habit. And once you create an habit, then over a period of 3 to 4 months, you will be able to complete this entire package. And once you do that, take it from me, you are going to attain mastery in financial analysis. Okay, so that's the assurance from my side. So thanks a lot. Thanks for believing me and committing your hard-earned money on these courses. And thanks for your time. Thanks a lot for the trust. Okay, thank you very much. This is my acknowledgement as well as my assurance. Yeah, anyone else in the process of registration but facing difficulty, let me know. I could see Shrikant initiated the registration. Let's see what is the status. Anyone facing difficulty with the link? If you are looking for Google Pay option or Phone Pay option, let me know. And all of you who are enrolling now, you will be getting a WhatsApp message post webinar, and that will give instructions as to how you can access the courses, how you can install our app, and how you can join our Telegram community as well. Okay. Yeah. Shrikant, are you facing difficulty? Yeah, let me just check this side. Yeah, Damodaran, from YouTube. Okay, Srikanth is facing difficulty with the link. Are you comfortable with Google Pay or Phone Pay? If yes, I can give you access live on screen. Okay, you can go ahead with Google Pay. This is my number, 77360 Okay, this is my number. Just go ahead with the payment. Once you complete the payment, let me know live on screen. I'll be giving you access. Okay, you just have to give me your email ID and I can give you access live on screen. Yeah, Prashant, I received your message. Thanks a lot. Thank you. And Srikanth, once you are done with the payment, let me know. Let me know with your email ID. Okay. Email ID, even I can pick from here. Okay, I'll keep it ready for Srikanth. Yeah. Okay, so it's here. Once Srikanth completes the payment, I'll be making payment. I'll be adding the course here. Okay, so it's all done, all set. Just waiting for confirmation from Srikanth. With that, I'll be able to give access. Okay. Let me just check. Yeah, Rupender, you can leave now. You'll be getting a WhatsApp message and that will have all the instructions. Okay. And thank you. Thanks for your time. Yes, Srikanth, I have received your payment of 2,994. This is an acknowledgement message. I have received your payment and thanks a lot. Thank you very much for your trust. Thanks for investing your hard-earned money. Okay, so what I'm going to do now, Srikanth, just have a look at the screen. I'm going to give you access to financial and credit analysis mastery bundle. Okay, it's confirmed. It means access is given. Thank you very much. Thanks for the trust. Thanks for investing your hard-earned money. As already I mentioned, just spend that 30 to 45 minutes every day. That will ensure you are going to achieve mastery here, okay, over a period of 3 to 4 months. Yeah. Rupendra Singh, yeah, what about certificate? Yeah, sorry, as far as the certificate is concerned, this is the code. Make a note of this. The code is FA250421. Okay, FA250421. Yes, Srikanth, I'll tell you how to log in. Okay, and there is a link for certificate. Of course, you will be getting an email. As I said, you will be getting an email. But let me give you the link for claiming your certificate. Okay, so you can see there is a form, webinar certificate request form. You have to fill this form and that will ask you for this code FA250421. Submit this. Certificate will be issued 3 days from now. It means it will be issued on Wednesday. It will be issued on Wednesday. Yeah. Now, how to access this. Whoever have enrolled, how to access, I'm just showing you the process. Just a moment. Just give me a minute, and Srikanth, you will be getting a invoice now. I'm just pushing that. Just give me a moment. I'm doing it for Srikanth. Okay, Srikanth, you will be getting an invoice now. Once that comes, it will become even more easy for me to explain. Let's see. Yeah. 5 minutes. I'm just checking it. Yeah. Okay, so I hope you can see this. Yeah, Srikanth, this is an acknowledgement. Yes, I have received your fee through Google Pay. And just have a look at this. In this invoice, you can see you can access the course on our website here. So this is our link. This is our e-learning portal. Click on this. Click on this. It will take you to our e-learning portal. On the top right, it will prompt you to login. Okay. Click on login. Give email, that is your user ID and password, whatever you have created. Then click login. Once you do that, you get inside the e-learning portal, and here you will see my courses. Okay, instead of courses, you will see my courses. When you click on my courses, you will be able to see whatever courses you have enrolled. Now you have enrolled financial and credit analysis mastery bundle, you will be able to access that. Okay, so as simple as that. Is that fine, all of you? Srikanth, is it okay? Srikanth, are you there? Yeah, okay. So the process is very simple. Even if you miss something, do not worry. You will be getting a WhatsApp message and that will have complete set of instructions. Okay. Yeah. So with this, we'll wind up for the day. Now the time is 11:13. We'll wind up and we'll catch up tomorrow. Okay, so tomorrow also we'll be conducting this webinar. So if any of your friends will be interested, please let them know that there is a session happening. So this entire week, we have planned this session on financial analysis every day, 9 p.m. exclusively for this week. Okay, so thank you all. It's going to be the same content, same content. We are targeting new audience. Same content, new audience. Okay. Yeah. Thank you all. Good night. Yeah, Umesh. Thank you. Thanks a lot. So Naveen, thank you. Rajesh, Srikanth, Umesh, all of you. Thank you. Good night.